All right. So let's just wait for the others to join.
Okay.
Yeah. So are you also doing any challenge? Are you doing any challenge right now?
No, I'm getting it, what you're saying.
Okay, awesome. Like I meant with my FOREX fund program. Are you doing any challenge with them? Any program?
Yeah. No, I haven't tried yet.
Oh, okay, you've not tried yet. Okay. So I'm starting mine next week. I'm starting my yeah. I subscribed for the 10K one. So let's see how we do it.
Okay.
Yeah. Okay, no one is joining. No one is joining. Let's give them a little bit of time. Okay, I think the other guys will find this. Yeah. So what we have here is first resistance, second resistance, and third resistance. So according to support and resistance traders strategy, the more touches a level has, the more likely it is to work. The stronger the level is. That's how support and resistance traders think or trade. So when the level has multiple touches like this, meaning it's most likely to work, but which is actually the opposite. But because the more touches a level has, the more likely it is to be broken, because smart money guys will know exactly where there's a pool of retail traders. They know where there's a cluster of stop losses, and what they have to do is just take price slightly above the resistance, and then that will be enough to take them out. After that, the market will go in their favor, and then they'll be left with their hands in their head thinking, but how? I knew the market was going to go down. I knew it, but you've been taken out. Okay, so we have to identify the liquidity before we become the liquidity ourselves. So make sure you identify the liquidity. So we have to avoid trading from a level where it's been touched several times. So this is how it is. So the smart money will know that, because they know how most retail traders trade. When they have a resistance like this, they will know that price is likely just to take them out and then just drop. So at this level here, they'll put their stop loss slightly above here, and guess what? The market will come to that level, take them out, trigger the orders from this level, and then we drop. So this, what you're seeing, is the fake out setup version 1, where we only have the resistance. Okay. The other type you're going to find is which we call an SR flip. Okay, where we have the market acting as support from somewhere at this level here. Okay, where the market is acting as support, and then the support will be turned into resistance, and then it's the same thing just here. So let's just focus on this for now. So I'm sure most of you have seen that we only trade one setup. Have you realized that?
Yes.
What do you think it's why do you think it's like that? Like, I'm always trading one setup. Why? Why do you think it's like that? Or maybe it's important for me to have 3, 4 strategies.
I think the reason is we're trying to be consistent. At least once you master one strategy, try to be consistent with it. Like, for example, me, from the time I started having these mentorship lessons with you, I've noticed that most of the setups are the sell setups. Hence, even when I'm looking for the setup, I'm just looking for the sell setups. So for the time being, try to stick to one setup that is working for you.
Right. Awesome. Great. How about others? Hello? How about others? What are you saying? Because a lot of traders out there that are trading different strategies, different setups, different strategies out there. You end up confusing yourself at the end of the day. So it's simple. One strategy is enough. One setup is enough to make you a consistently profitable trader that we all want to become. So we just need to find a strategy that aligns with us, that we actually understand and have taken time to back test, forward test, and over a series of trades, it has shown positive expectancy. That's what we need. That's all that we need. And then you just need to consistently, objectively identify the setups, and as long as it meets the criteria, you take a trade. As long as it meets your criteria, you take a trade. Why? Because anything can happen in the market. You don't know which trade is going to win. The same trade that you're actually doubting that it might not win, that's the one that ends up winning. The one that you think is going to actually win, it might be the one that ends up losing. So we don't know which trade is going to win. So every time we see our setup, we have to trade without hesitation, without fear, because we have seen it work in the past, and therefore there's a higher likelihood that it might work. That's the reason why we always have to use a stop loss, because there is no certainty. I mean, if we knew for sure that the trade was going to win, I mean, all of us would have been billionaires by now, because we were just going to be taking trades because we've seen it work, so it will work. And there's no use of you using a stop loss. Don't be no need of you using a stop loss. But we use the stop loss because we know that anything can happen. But somehow, some people still don't understand why they're using a stop loss. Okay? So that's how it is. So when we see this happening here, this tells us there's likelihood of price pushing to the upside, taking out the liquidity above. So for now, I'm sure you've seen there are different setups, like I said on this part, on the progress part. So there's a diamond setup, there's a compression. So let me just show you how these two look like. So you have the same path like this, and then for the compression, you have the market approaching your level like this, compressing. Okay, as it's coming to your QML, it will be compressing like that, compressing like that, and then eventually it's going to drop. So when you talk about the compression, it will look something like this. So literally, the market is literally compressing. As it's coming to your level, it will be compressing as it's coming here. And then eventually, it's just going to drop, okay? But that doesn't happen most frequently, okay? That doesn't happen most frequently. That's the reason why we're only able to stick to this setup, because it's the one that mostly it's common. It's always there most of the times, okay? So it makes my job easier. When I open a chart, I know exactly what I'm looking for on the chart. I know exactly what I'm looking for. And if the setup is not there, if the market is not giving me any setup, then I go to the different setup. Okay. So for now, just master this setup right here. Master the fake out setup. So this is what? This is my progress. So we have the past, we have the progress, and then we move to the approach. So this is my progress. So progress You just have to make sure that the market is giving you fake outs here. Make sure it can be a double fake out. It can be 3. It can even be 4. This kind of setup, I mean, fake out can be can be in the middle. It can be here, or it can be somewhere at the end there. It doesn't matter. As long as you have the market coming to your resistance 2-3 times, that's your fake out zone. So it's called the fake out zone or a liquidity zone. So forever, let's use liquidity zone. Okay, we use this one, liquidity. We use this one here, liquidity zone, right there. So this is our liquidity zone which has been formed. Why? Because there is liquidity above this resistance. There are a lot of stop losses around this level. There's a cluster of stop losses here which needs to be taken out before price can reverse. So apart from this, the next one is what we call the approach. Okay, the approach. So what is the approach? Okay, so this is the progress. Now the approach. So the approach is literally, we're just talking about how the market approaches your tradable zone. Okay, how the market is approaching your zone where you are supposed to sell from. What do you expect from here? So on this particular level, what we want to see the market showing us a sign of rejection. We want to see the market being rejected from this level here. And as the market comes here, most frequently, you are going to realize that you have a big candle breaking structure here. You're going to have what we call a Marubozu candle breaking the structure here. Okay, there'll be a big candle breaking the structure there. Okay, so once we see that, that should give us confidence that the market is heading towards a tradable zone. So which one is our tradable zone? In this case, this is our MPL. Our MPL is a level where we want to sell from. In this case, when we have the MPL. Like I said, you won't always going to have the MPL. It's not always that this is going to actually be there. So please don't hesitate when you find a setup with no MPL. It's also valid. Okay, as long as it has given you confirmation to sell, please take the trade, because there's no way to know whether a trade is going to win, and it's not always that the market is going to give you an MPL. So like I said, the market, the kind of candle that is going to break this resistance here, usually it's going to be a nice momentum candle to the upside, and then after that the market drops. So what you need to see here, make sure that you see price being broken by a nice candle, and then your confirmation, you want to see your confirmation for entry. You want to look at the reversal, bearish reversal candlesticks, bearish reversal candlesticks, and bearish reversal patterns. So I need us now to discuss about. So I need you guys to tell me at least each one can tell me 2. So someone to tell me 2. So we are, how many are we? We are 6. We are 6 here. So at least let me get 1 each. So tell me whether it's a pattern or it's a candlestick pattern or a chart pattern. So please tell me any of the bearish reversal patterns that you know.
The one is engulfing, bearish engulfing.
Bearish engulfing, very good. What's that? What's the other one?
And the pin bar, the bearish pin bar.
Yeah, bearish pin bar. Okay, great. How about others? So his doctor is given us a bearish engulfing pattern, a bearish engulfing candle, and a bearish pin bar. Okay, awesome. How about others? Hello, how about others? People, let's go. Bearish reversal patterns. It's quiet over here. What's happening? Huh? Nchemuya, do you know any bearish reversal patterns?
Do I know any what?
I know, I'm just teasing you. Yeah. Okay, Mr. Mwala. Mr. Mwala. Mr. Mwala, are you there? Tandy.
Yeah.
Mr. Mwala,
I'm here.
bearish reversal patterns.
A shooting star.
A shooting star, okay. What else?
You've heard that, Mr. Jibun?
Yeah, I've heard, yeah. What's the other one? Okay, Tandy.
Okay, I'm behind on this one. I only knew the bearish engulfing and the bearish pin bar, which has been said.
Okay, how about my brother here? Hello?
How about?
No, I'm asking this guy here, my other brother here. Anyone else? Okay, so those are good. So those are candlestick patterns. Those are reversal candlestick patterns. So we have a bearish pin bar, which can also be referred to as a shooting star. And then we have a bearish engulfing pattern, right? Nchemunya.
Yes, please.
What is to engulf?
To swallow, to swallow something.
Yeah. So when you talk about
or to cover up something.
Yeah. Yeah.
Sorry guys, I was stepping out for a minute. Okay. I hope I don't miss a lot.
Yeah. So we're asking, give us some types of bearish reversal patterns, bro.
You can find like a hangman, that's what they call, right?
Which one?
Hangman.
Okay.
What else? Shooting star that I know.
Yeah.
I don't know a lot, but yeah.
Yeah. All right. Thank you, bro. So we have a lot actually. We have a lot. There's what you call a tweezer top. Yeah, we have a tweezer top. We also have we can have what else? So those are candlestick patterns, and then we also have chart patterns, right? We can have a chart pattern like a rising wedge. Do we know a rising wedge? Do we know? Do we see how a rising wedge looks like?
No.
We know, right? So hello, are we getting me?
No, sir. I don't know.
Yeah. So a rising wedge. So those what you've mentioned, those are the confirmations you look for when the market has reached your tradable zone, which is this level here. Those are the kind of confirmation that are going to tell you whether to sell or not if the market has reached to this level. Just because we know that the market is likely to respond to this level doesn't mean that it's going to automatically sell from that level. So there'll be times when the market just goes to the upside like that without respecting this structure here. So we always have to wait for confirmation. There's no point at which you should trade without confirmation. We always have to wait for your confirmation before taking any trade. That gives you a little bit of confluence. Okay, yeah. So when I say an engulfing, a bearish engulfing, so what we mean is that when you have a candle going to the upside here, that's a bullish candle, which is a bullish candle going to the upside. And then when that candle is covered or swallowed by the bearish candle, which is pushing price to the downside, that's confirmation for us that the market is most likely going to go down, because it's actually in our level where we expect the market to drop from. So that's the reason why it's called the bearish, a bearish engulfing pattern. So I'll send you the books so that you can look at the candlestick patterns. Yeah. So here, this is our zone. So overall, this is what we call a rally base drop supply zone. Remember what I showed you in the beginning? Remember the 4 types of zones I mentioned? Please let me get some feedback. Let me get some feedback. Are we tired already? Are we tired?
No.
Yeah. So here we have a rally base drop supply zone. So I'm looking at this. So this is a rally. So let me just draw that out for you guys. Yeah. So this is it looks like this. So this is a rally. A rally is a push to the upside. So the market going to the upside, that's a rally. Okay. So this candle will be green. Yeah. So you have a big candle going to the upside. And then at this level here, you have the market consolidating. So by consolidating, I know those coming from a medical field will, yeah. So we have a consolidation. We also have consolidations here. We have a consolidation here as well.
Okay.
Yeah. Not pulmonary consolidation. Yeah. So we have, so it will look like this. So this is a rally base drop. Okay. Now in this case, this is a reversal kind of QML. I mean, a reversal kind of supply zone. But sometimes what you're going to have, you have a drop-based drop, a drop-based drop kind of supply zone, where you have something like this. Okay, where you have the market dropping from this level, and then it consolidates here. Okay, so Tandy, what do you call this kind of supply zone?
This is a drop base drop.
Yeah. So this is a drop base drop supply zone. Okay. So on the lower time frame, it might look like this, drop base drop. But overall, we know that this is a rally base drop. And then sometimes what you're going to have is something like this. Let me just show you. Sometimes at this level, you have just an engulfing pattern. We have a bearish engulfing pattern. Yeah. Sometimes you won't have you won't like see this thing. Don't worry. I'm going to, from here, I'm going to show you a chart example on a beautiful trade that we took the other day on a Euro USD. I'm going to give you an example and I'll explain the same things. It might not make sense right now, but trust me, it will. Yeah. So what we have here is what we call a bearish engulfing. Yeah, so let me just push that. I don't know, kind of slow. I don't know what's happening. Yeah, sometimes you're going to have, I don't know, it's failing to move, can't move. Yeah, okay, yeah. So let me just change the color to red. Let me just change this color to red. Yeah. So you see, so this candle here has been swallowed by this red candle here. So that's a bearish reversal pattern. I mean, a bearish engulfing pattern candle. So once you have that, meaning you want to sell at this level when the market comes here. Of course, you have to wait for confirmation. We don't just sell blindly. We wait for confirmation. Okay, always important. So sometimes you can have this, and then this one is just going to be small sometimes. Okay. So, what is a bearish order block? Does anyone know what an order block is?
An order block, isn't it the candle which is like big, like the engulfing candle?
Okay, how about others?
I know about the order block, but I don't know how to explain. But in a downtrend, there is a small bearish candle, and then the small bullish candle make, and then the bearish pattern continue. That
Okay.
small portion is called order block.
Yeah, yeah, great. So a bearish order block, like my brother just said, in an uptrend, okay? So when the market is in an uptrend, we are looking at the last bullish candle before the bearish move. The last bullish candle before the bearish move. So this is the last bullish candle before the bearish move. So what we do is we get this horizontal, I mean this rectangle tool, then you cover that candle there. That becomes your order block. So once the market comes to that level and it gives you confirmation, usually you're going to see a big rejection there. We're going to have a wick, a nice candle there with a doji with a long wick. Then that's your confirmation to sell from here. So this is the bearish pin bar. This is the bearish order block. So for the bullish order block, it's just the opposite. So bullish order block, we're going to look at it's a last bearish candle before the bullish move. The last bearish candle before the bullish move, that's the bullish order block. The last bullish candle before the bearish move, that's your bearish order block. So yeah, simply we just wait for price. For those reversal patterns that we've mentioned, we just wait for price to actually come. And once we've seen those, and then we actually enter right there, meaning we take a trade right here. Okay, so when we are taking a trade from an MPL, our stop loss is going to be slightly above the order block, slightly above the MPL. That's where our stop loss is going to be, and our target is going to be at the next fresh demand zone. So by fresh demand zone, I mean a demand zone that has not been used. Okay? We know that once the level has not been used, it has a higher chance of actually containing orders that can actually push the price to the opposite side. So even this level here, we have to make sure that it's a fresh zone. A fresh zone is just a level that has not been touched, and it contains fresh orders there that needs to be filled. So we remember that. So we just wait for price to come to our level. Once price comes to our level, and then we wait for a confirmation. The stop loss is going to be above the MPL. If you don't have an MPL in that particular case, you only have the higher high here. we do the same thing. Your stop loss is going to be above the higher high. Okay, so a stop loss, Nchimunya, it's just, this is a tool, it's an order that tells us, that helps us, one, to prevent us from losing a lot of money when we are wrong. No, not when we are wrong, when that trade has been invalidated. Okay, then another role that it plays, it also helps you. It helps you by telling you that that setup has been invalidated. So it just plays two roles: protecting your account in case you are wrong, and then also tells you that your setup has been invalidated. So in trading, we know we should be able to actually predefine our risks every time we enter into it, before we enter into a trade. Sorry?
अभी लेने चले बनाना, लेने चले, नहीं भी थोड़ी देर में लेने चलते हैं, मॉरिशस जा रहे हैं हम।
So those are the roles of a stop loss. Did you get that? She left?
I think so, yeah.
I think she's there. So that's a role of a stop loss, to invalidate our setups and also so a role of a stop loss is to prevent us from going into further losses in case we are wrong on that particular trade. And also number two is to invalidate our trading setup. So when we want to sell from this level and the market continues to go to the upside, just tells you that the setup didn't work and it should be out of the market because your edge is no longer existing in this setup. Therefore, it prevents you from losing a lot of money, because if you don't put a stop loss and the market continues to go against you, you lose a lot of money. But when you already know where you're supposed to get out, if the market doesn't go in your favor, then that's smart. But unfortunately, most people don't even use the stop loss. Unfortunately, that's the reason why we have a higher failure rate of traders, because people don't want to stick to the rules. A stop loss is a must. At no point should you find yourself in a trade without a stop loss, please. So this is how it is. Our setups usually has a risk to reward ratio of 1 to 5 and above. We don't take any trade that gives us a risk to reward ratio of less than 1 to 5. All our setups have 1 to 5 and above. So that gives us room to error. Even if we lose 7 out of 10 trades, just taking one good trade with a risk to reward ratio of 1 to 7 already takes us into profit. If these other 3 trades wins, already will be so much in profit. So the only thing that we should be able to do is consistently and objectively identify our setups every time we're looking into the chart and into our setups. Make sure that you know exactly what you're looking for. And if the setup is there, you take the trade no matter what. As long as it meets your criteria, take the trade. It's not your job to find out if a trade is going to win or not. So what you just need to know is, how much am I willing to put on this trade to find out if this trade is going to win? And you should be comfortable risking that amount of money. And that amount of money should be between 1 to 3% of your account, nothing more. Because there are no guarantees. There's no guarantee that this trade is going to win. Therefore, the only thing that you have control over is your risk management. No wonder I always preach about risk management, because we don't know which trade is going to win. It's about probability. It's all probability. Therefore, there's no way you should be able to put so much on a trade with the hopes that it's going to actually win. That's the first way to blow your accounts, trust me. I've done that several times in the past. It's dangerous. You don't have to do that. Make sure you predefine your risks every time. Know exactly how much you're going to lose by using using a risk calculator, a position size calculator. Every time before you take a trade, make sure you know exactly a dollar figure of how much you are risking if that trade goes against you. That's the first thing you should be able to look at. So our setups always gives us a very, very good risk to reward ratio. One thing I love about it, okay? Nice risk to reward ratio. Yeah. So I think on this particular part, I'm done. Now I need questions from you. I need questions from you.
Okay, I've got a question.
Yeah.
Say, for example, sometimes it happens, you confirm, quite all right, you've gotten your confirmation, there's a bear reversal candle there,
Yeah.
and then you end, but suddenly it goes up, it takes you out.
Yeah.
Even if you had made an analysis, I think I did one on Thursday, and that was on Australian dollar, Swiss francs.
Yeah.
It took out. So once it takes you out, that seat you have to be out. You don't have to come and enter again, even if you come and identify now like another reverse confirmation. Is there like okay? In short, in simpler terms, is there another reconfirmation after you've been stop hunted?
Okay. That happened also. Yeah, that it happened also on GBP USD. The same trade at the same time I took the Euro USD trade. The same thing happened. So the market just came here, gave me a confirmation. I entered. The market dropped a little bit in my favor, and then it went to the upside. I remember that at a particular time, I wasn't even looking at the chart. I found that the market has dropped. So if you are lucky enough to find that the trade is starting to go down, and you have some sort of confirmation, and that you are confident, of course, you know, and you should be able to put a stop loss. Yes, you can re-enter, but it's not really advisable. Sometimes what will happen, maybe that move to the downside is just a retracement before the market continues to go to the upside. So it's not very wise for you to do that, but I've seen that happen several times where market takes you out and then immediately the market goes down. So no wonder it's very important that you put your stop loss slightly above the higher high. If you put it just too close to the higher high here, the market will always just step you out and then go in your favor. So always make sure that you put your stop loss slightly above the higher high, always. Okay. So yeah. So sometimes you can actually use what an indicator called an ATR. ATR is an average true range. So what this one tells you is that it tells you on average how that particular pair moves in that particular time frame, whether it's 5-minute time frame or 1 hour, it will give you an approximation, okay, down there. So what you can do is that you should say your stop loss, if your stop loss from here to here, let's say it's 20 pips, and then the ATR is showing you, let's say 15, right? So your stop loss should be at least 1.5 of the ATR from the higher high here. So you should get that number, whatever the figure the ATR is showing you, you should say, okay, this, if it's showing you 15, you can say, okay, 15 pips plus 1 plus like 15 plus half. So let's say 20 pips, meaning your stop loss is supposed to be 20 pips from the higher high to somewhere right there. But most of the time, what I've seen, once the market just takes you out from there, usually the market just continues to the upside. There are some cases where the market will just take you out and drop in your favor. I mean, you can't win all the trades. So the most important thing, you need to accept to be wrong. So the problem with most of us, again, we usually have that ego. We say, I can't be wrong. I can't be wrong. We're taken out, try to enter again, and then it takes you out again. And you're like, what am I doing? So once it takes you out, just accept the loss, accept a small loss, and then go to the other trade. Like there are a lot of these setups. There are a lot of these setups that will actually give you. Personally, I go like every time I'm looking at the charts, like maybe in the morning, for me to find setups to trade, I usually go through probably like 45 pairs. So what I do is that after screening those 45 pairs, I'll probably come up with maybe 5-6 setups, sometimes even 3. Okay, So I'll go through those pairs just to try and sort and spot my setup. After going through that process, then I'll come up with my watch list, 5 of 6 trades. Then those are the trades I'm going to be looking at. If I have confirmation there, I take the trade. Okay. Once you actually get it, it becomes, I mean, it's less stressful and less strenuous, because in 1 minute, if I look at the chart, I'll know whether my setup is there or not. In literally 1 minute, I'll know whether my setup is there or not. And if it's not there, I'm not going to waste my time. I'm not even going to waste my time, because I know my setup is not there. My edge is not there. So there's no reason why I should be in that particular trade. So with time, you're going to develop the experience to be able to spot these setups. Once just open a chart, go to maybe to your 1 hour time frame, look at the chart, look to your left. Do you have your past? Make sure you have your past. QML, low, higher high, break of structure, and the lower low. Once you have that, great. Then you analyze the setups. After you analyze the setups, create your folder where you get a screenshot and you put it and mark it as before. For example, if this is your